So this video is a list of things specifically geared towards retirees that you should be looking at doing or at least reviewing on an annual basis and pretty commonly at this time of year. Now, we're sitting here today as I'm recording this on December 8th, and so this isn't something that you're going to accomplish if you have to tick off every item in the list between now and year end. That's something that you want to start a little bit earlier than that. Some of these things you can accomplish on January 1st. A lot of them you have to wait till the November, December window just because of the nature of how they work. But this is more or less evergreen content. This is stuff that you can do every single year. So if it's not something that you were able to get to this year, don't worry about that. Just keep it in your back pocket and make sure it's something that you get better at over time. For those people that are pre-retirement, most of these items will apply to these people also, probably 80% of them. But a lot of this content's geared towards people who are retired already. So without further ado, we'll get to these 8 items. Not in any way an exhaustive list, but these are things that pretty commonly apply to a lot of different people as I see them. So number one is, if you're over 65, review your Medicare coverage. Now, most people's Medicare coverage, whether they're on Medicare Advantage or original Medicare, doesn't change a lot every single year. Your Medicare supplement policy, for a lot of people, you might carry it your entire life. If you're on Medicare Advantage, sometimes those switch around a little bit more, but specifically what we're talking about in reviewing Medicare coverage is Part D. So Part D is the component of Medicare coverage that covers drugs. And there are a lot of reasons why it's so important. One is that you may take different drugs over the course of your retirement. One is that plan formularies change every year. Plan formularies are what designates what is covered and to what extent by the plan that you have. And because those can change so commonly, it's important to review this on an annual basis. Now, Medicare's got a great tool on their website that filters through this stuff where you essentially just list your drugs in your pharmacy. And then you can go through and look at plans on that site and compare different ones with what you already have. It's important when you review that list that you look at the drug plus premium cost comparisons rather than just one or the other, because there are instances where you might have a plan where the premium is much cheaper, but it doesn't cover your drug nearly as well. And so the total cost of those plans could end up being an unexpected surprise for you. If you're under 65 and you're not on some sort of retiree medical coverage, that means more than likely you're on an Affordable Care Act plan. If you're not on any plan at all, you need to review that ASAP. But if you're on an Affordable Care Act plan, there are quite a few reasons you have to review that annually. Number one is that your plan may not exist next year. It's still a relatively new law, and there is a ton of turnover in these plans. The second reason is that you have to make sure that if it does still exist, it's the most cost-effective option. There's not any penalty for switching between different Affordable Care Act plans. And so it's important that you make sure you stay on one that is the most cost effective and makes the most sense for your situation financially, medically, and for other reasons. And those do change pretty frequently in these plans. You see huge costs and premiums, especially as new players enter and exit the marketplace. And so that's something to look at. And then the last thing is that you have to make sure your income aligns with what your plan is, because these plans have fairly significant subsidies factored into them. And if you don't do that correctly, if you blow through one of your subsidy levels, you might end up having to pay a significant portion of your premium back, and that's a bad surprise for most people. The second thing that we want to talk about is making sure you take your RMDs if you're age 73 or older. RMD stands for Required Minimum Distribution. The penalties are not as bad as they used to be. If you have some type of retirement plan, most likely you're going to have to take money out of those past age 73. And it works a little bit differently with every single type of plan. It used to be that the penalty if you didn't take it was 50% of what the RMD was supposed to be. They've softened those penalties quite a bit. Now you're looking at, I think, a 25% penalty and as little as 10 if you get it corrected in a reasonable amount of time under a couple of years. So a knockoff of RMDs are QCDs, qualified charitable distributions, and you can take those as early as 70 and a half. But for people who are charitably inclined, that's a great way, if you don't want to spend your RMD, that's a great way to give money to charities that mean something to you and at the same time reduce your RMD. So if you have, as an example, a $50,000 RMD and you send $25,000 to charity, that $25,000 that's sent to charity is not taxed, and it also reduces your RMD by $25,000. So it's a helpful tool for the charitably inclined, something to keep in the back of your head, and it works very different to take a QCD than to take an IRA distribution and then personally give the money to charity. That requires a very different mechanism, and you probably aren't going to get nearly as much benefit out of it from a tax perspective, if any at all in some instances. The other thing you have to keep in mind is that IRAs, if you have 6 of them, you could aggregate all those IRAs and just take one RMD as long as it covers the total amount you need. That's not the case for everything. RMDs from a 401k are an exception. You have to take them individually from each plan. You can't aggregate them. 403Bs you can aggregate, but you can't. You also can't aggregate things like your 401k and 403B and IRA all together and just take one RMD. So from a plan type perspective, it's important to know what applies to you in the case of RMDs. Number 3 would be reviewing taxable accounts. This is one of the things that you typically have to wait to this time of year for, especially if you own significant amounts of mutual funds and specifically actively managed mutual funds in your taxable accounts, because this is the time of year that they typically distribute capital gains. So it's important to review those, and you want to review those for a couple of reasons. If there are large distributions, you need to decide whether it's more advantageous to keep the funds that you own, or if you want to sell those funds to save from a tax perspective and potentially shift those funds to something more tax efficient, like an ETF that maybe holds the same thing, or if your investment objectives have changed, potentially something different. But in any instance, something that is more tax efficient. The other thing is, if you've taken large distributions from taxable accounts over the year and potentially accrued quite a bit in capital gains, that's something that you may want to do some tax planning for it and make sure that you're not under withheld when tax filing deadline comes around. The next thing that you want to look at beyond reviewing taxable accounts is reviewing your financial plan. Now, this could easily be number one, and everything else could fall underneath it. But I say it's important to review your financial plan at least annually, because you need to see a lot of things, right? Does your distribution rate, inclusive of what's happened in the markets in the previous year, does it still hold up well in probability analysis? Is there still a high probability that you're going to meet the goals that you set out, whether that goal is to maximize your own income or to maximize some sort of legacy that you are leaving to your kids or to some sort of charity? That's an important thing. The other thing I think a lot of people miss from a financial planning perspective is if you feel comfortable with what type of legacy that you're providing, given that's your goal, does it provide that same legacy on an after-tax basis? That's an important thing to understand. And it's very, very different for different people depending on their goals. People who are trying to leave a large legacy to a charity will leave that in a very different way than people are trying to leave a large legacy to their kids, because obviously the tax status of kids and charities are very different. You don't mind leaving significant embedded tax liability in an estate if it's going to a charity, whereas if it's going to kids, and your goal is to leave them as much as possible, you want to take as much of that embedded tax liability out as possible. And that's where things like Roth conversions and gifting and managing your cost basis over time are so important. The next item, which is inclusive of and duplicative of the prior two on the list, is reviewing your tax plan. So one of the things that I think people get caught up on in tax plans, especially early on in retirement, that's a huge mistake, is that they think of a tax plan as a one-year thing. They think of it as a game, as how do I decrease my tax liability as much as possible? And it's something that happens a lot with accountants too. And it's not so much accountants' fault. Accountants typically have a siloed view of your taxes. They have a view of your taxes in the year that you give them to them. This is one place where I think advisors have an advantage on a tax planning perspective, is because you have a 30-year view of what's going on in this tax plan. And it's your goal as an advisor certainly to make sure not that the client pays the least taxes in this given year. Your goal is to make sure that the client pays the least cumulative taxes over time. And you can really only do that if you have a 30-year view of these types of things. So when you look at your tax plan, don't be so myopic as to try to reduce the tax liability to zero in this year, where it's ultimately going to cost you a lot more down the road. This is where things, again, like Roth conversions come in, potentially taking capital gains. Maybe you can take some capital gains where some of them are in the 0% bracket. There are a lot of things that you can do to prepare yourself for further down the road with your tax plan. Just don't look at it as a one-year thing. And for more specifics, think of things like net investment income tax, how marginal tax rates may change over time, how your tax rates may change when you ultimately start taking required minimum distributions, how that could lead you into things like IRMA surcharges for Medicare. Those are important things to consider, and it's best to consider them as far out as possible so that they're not so hard to fix further down the line. The next thing that we want to look at, number 6, is depending on whether or not you've claimed Social Security. If you haven't yet, it's good to review every single year if your long-term plan still makes sense. So certainly for people that have enough assets to cover their current income and they plan on living a relatively long time, let's say past average life expectancy, it's usually best, not always, it's usually best to delay as long as possible. So that's one thing you want to consider every year. A lot of times people, even those that are planning on waiting until 70, will find that maybe something in that 68, 69 range, as far as age is concerned, ends up being the best option for a lot of different reasons. It just depends on your own plan. It depends on your situation with your spouse if you're married, because in that instance you have to consider the combined impact of Social Security. It's just a good thing to review every single year and make sure that you're still on track For those people who have claimed Social Security, in most instances, there's not much to do, but there are life events that come up that could impact whether or not you should consider making a change with your Social Security. So just to give you a one-off example, it is possible once you've started taking Social Security after you get to full retirement age to actually pause your benefits and delay them until age 70. And an example of a situation where that may make sense is, let's say that you inherited a large sum of money and maybe a lot of it was IRA money. Well, today, if you're non-spouse and you inherit that type of money, it's typically got to be gone out of that account in 10 years. And if these are big accounts, more than likely that's going to create a significant tax liability for you. Well, if you're taking Social Security right now, immediately all that Social Security is going to be taxable, at least 85% of it, and it's going to be taxed at a pretty high rate. So why not, in that instance, if you have to pull the money out of the IRAs, just replace that income with the IRA money, pause your Social Security for 3 years. You can pick it up again in those 3 years at a higher rate, and the 3 years that you missed, you won't have dealt with the same type of tax liability for your Social Security. So think about things like that. Number 7 would be reviewing your investment plan. This is something that everybody does every year. People think of investments as the most important thing. They certainly are very important. I don't debate that. But what you want to find out really is your investment plan consistent with your goals and values, and does it give you some level of comfort? And I don't mean comfort in the sense that it can't move, you can't realize any sort of volatility. In most instances, you're going to have to deal with some level of volatility if you want to get reasonable returns over time. There are ways around that: insurance products, structured products. There are a lot of things that you can do if you're not the type of person that can deal with that. But more than anything, you want to make sure that your investment plan is reflective of your financial plan and reflective of your values. And keep in mind that maximizing returns isn't always the number one goal. You want to have as high returns as possible within the confines of your own comfort level and the confines of your plan. And the last thing is not so much a part of your financial checklist. It's reflect on your relationship with your money and your financial plan. Ultimately, money is just a tool. It's just a tool to allow you to enjoy your life, and it's a tool that allows your life to reflect your values. But for a lot of people, it's just a constant source of anxiety. So if it is that for you, this is a good time of year to reflect on that and figure out what kind of things that you can do to improve upon that. That could be that you need to save more money. That could be that you need to decrease the risk in your portfolio. That could be that you need to do a lot more work to put together an estate plan. No matter what it is, if your money is causing you more anxiety than the enjoyment you get out of it, then it's time to reflect on things and consider making some changes. So that's 8 things. Like I said, not an exhaustive list. Hope it's helpful for people. These are things that apply to you in every single year. So come back to this over and over through time and make sure that you're checking these boxes as often as possible.